Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing in that order. Today is Monday, December 9th, 2024. Today's episode begins with Macro Daily Reminder Monday. Daily reminder number 1. The 2-year, 10-year Treasury yields were inverted for over 2 years, with bull steepening reversion occurring in September. That's 3 months ago now. Typically, when you have this inverted for this long, this is a bad sign. This typically is the kind of thing that you see before things like the Great Depression, suggesting that we may be headed into a pretty bad, extremely bad recession, if not a depression right now. By this metric alone, we might be able to say that there's a high probability of a major economic slowdown coming in the very near future, especially considering that the bad things usually happen when we get to the reverted state. Once the monetary policy of the central bank, the Federal Reserve, is done strangling the economy because, inflation was too high and they ease off a bit, that's where we are now. And this is the part of the cycle typically when things slow down. Daily reminder number 2. The 10-year break-even inflation rate has been in the range of 2% to 2.6% for 2 years. Contrary to what you may be hearing from other people who are rightfully fearful of future inflation continuing to maybe be a problem, the idea that maybe the Fed is, maybe relaxing rates too early. Just remember, this is exactly the same arguments that were right before the great financial crisis, by the way. Inflation was running hot and they were making cuts and people were making the same complaints then because the Fed, they saw what was coming and they see what's coming now, which is why they started the cutting cycle very recently. The 10-year break-even inflation rate, this is a humongous market that basically bets on what inflation is going to average over the next 10 years. And it has to do with the price of Treasury, inflation-protected securities, also known as TIPS, and the yields on the regular 10-year Treasury notes. So while you might be hearing other people suggest that inflation is going to go higher, as of right now, even today, specifically Monday, we're sitting at 2.27 and actually trending a little bit lower right now as it stands. This is all, by the way, along with not super weak jobs numbers that just recently came out. I wanted to add that in. Another piece of the inflation piece that I want to add to the daily reminders is the price of crude oil. If markets were detecting potential inflation rising, do we think that crude oil would only be at $68 a barrel? After all, it was, back in 2018 when things were supposedly cheaper, we were in this same exact range. Not only that, we have a pattern of sort of a head and shoulders looking top bumping along this trend line, and more recently bumping very aggressively on it, suggesting that this may actually break to the downside, and if that happens, there's no inflation. At that point, it's deflation. And as bad as inflation can be, deflation is what caused it was a big part of the Great Depression. So inflation isn't being priced to be very hot. Treasury yields, where we are in the cycle, suggest pretty strongly we're headed into a major economic slowdown. What else is important with the daily reminders? Well, something called the SOM rule was triggered in July of 2024. Every single time this has happened in the last many decades, this indicates that we are now in a recession right now. The SOM rule is triggered when the unemployment rate, you can find this yourself on the Fred, when it goes up enough from the bottom, as you can see, all of the gray bars are all of the recessions. This current chart view goes back to 1950. I know it's a little small, but the little gray bars here are the recessions. We have of 81, for example, of 1990, 2000, the Great Financial Crisis, and the COVID little crack there. And you can see during recessions, unemployment rises a lot. And what triggers it is this thing called the SOM rule, that once it starts to go up, it just keeps going up into the recession every single time. It does the same thing. And here we are. Can you see the curve at the end of the chart? Does that look like it's pausing, going sideways? It's going up. So although unemployment is comfortably sitting around 4. Oh no, I think it's updated to 4.2%. I forgot to update that. Although we're comfortable at this unemployment rate of 4.2%, the fact that it's been going this way suggests we may be headed into a slowdown as well. Put all these together, but wait, there's more. The S&P 500 is extremely expensive with a PE ratio of 31 and a CAPE ratio of 39. Now remember, folks, when it's very expensive, people feel very wealthy and are willing to spend more. What happens if this reverses? What happens if the market ever gets cheap and people don't feel so wealthy anymore? The snowball kind of rolls on itself and becomes a much bigger and worse problem, which I am fully expecting to come very soon. Robschild, PE ratios, CAPE ratios, what's that? Well, the S&P 500, the collection of the main stocks of the US, the PE ratio is the price that it costs for $1 of return. So companies make money, right? How much money do they make? Well, the stock price is ownership of the company. Sometimes people pay as low as $6 for $1 of return. So imagine buying a company, paying $6, and then to own a piece of that company, and for that $6, it earns $1 every year. Well, that happens sometimes. Right now, it costs $31 for $1 of return. This is extremely, extremely expensive. And it's not expensive because companies are earning less money. In fact, companies are earning basically the same amount of money that they've been earning over the past year, as far as this chart is calculating it for now. It will be updated soon, by the way. But as it stands, we are sitting at a price of, people are paying for stocks $31 for only $1 of return. That's really expensive. If Mr. Market decided that stocks were expensive and decided to go down to one of these historic low points of costing around $6 for $1 of earnings, that would indicate the S&P 500 dropping in price by about 80%, a little more than 80% right now. 80%, not 50%, 80%. And it's not out of the cards, considering that stock prices can sometimes trade at higher PE valuations and sometimes trade at lower PE valuations. To smooth things out a little bit, we also have something called the Shiller PE ratio, or the CAPE ratio. What this does is it's the price earnings ratio based on an average inflation adjusted earnings from the previous 10 years, known as the cyclically adjusted PE ratio, the CAPE ratio. The last time this became historically elevated was in 1929. And if you were buying stocks, reading articles saying everyone should be rich, stocks just keep going up, get leverage, keep buying stocks. You bought stocks in 1929, you would not have seen the value of your stocks get back to that same value in nominal terms for about 30 years. And that's not considering for anything for inflation. You wouldn't feel like you got anything out of your stocks for longer than 30 years. Imagine that. But, today, and what was the Cape-Shiller ratio then? 31. This is when stocks had never been more popular in the history of the United States. And then they became more unpopular than they ever were in the history of the United States for the longest period of time ever, about until the 50s, really, when Mr. Market decided to wake up and decide to make stocks popular again. Stocks aren't always popular, friends. Just for a longer term historical reference, they're not always expensive. You know, for most people watching this video who are probably maybe my age or younger, probably the majority of the audience here, you don't know, you have no idea what it's like when stocks are cheap. They're not cheap right now. In fact, the Cape-Shiller ratio is, if we round this up, it's 39 right now, which is, you know, near 30% higher than 1929, right before the Great Depression. Again, this isn't because of earnings contraction. This is because the price has just gone to the darn moon and everyone's feeling real happy and real comfortable and real safe and real rich at the exact wrong time. This is all while Warren Buffett and his billionaire friends, by the way, are dumping their shares, while the little dumb guy is happily gobbling them all up at these extremely high prices, these extremely dangerous prices. Now, PE ratios can make sense a little higher if you have treasury yields that are extremely low, but treasury yields, the return that you can get by lending money to the government for a guaranteed return is over 4% still. If this was down to like 1% or lower, if we were still in that situation where rates were just slammed super low, then PE ratios can make sense, because if the guaranteed return is like only a little bit, then it's like, it makes sense to take a little bit more risk for less reward. Paying $31 for the return of $1 doesn't sound so bad if rates are below 1% from guaranteed treasuries, but that's not the case right now. Treasury yields are currently over 4%. This is why I consider treasury bonds to be a fairly attractive place in markets at the moment. Next daily reminder, junk bond credit spreads are at historic tightness. Going back to the Fred website, the Bank of America high yield index option adjusted spread, this is junk bonds. These are basically companies that are borrowing money and having to pay more to borrow what they're borrowing because of the fact that they're higher risk. They're expected to have some of them go bankrupt. And what happens sometimes is people want to get more yield. They're like, the treasuries, they don't pay enough yield. I need more yield. And so they get riskier and riskier bonds, which drives credit spreads tighter and tighter. So when things seem risky and people are scared of investing, you can have junk bonds offering almost a 20% higher yield above the percentage yield of the treasury bonds. This is, by the way, when it's the perfect time to buy junk bonds, is when everyone is scared, and it's actually when they become that discounted, it becomes the safest and most profitable way of getting return. Unfortunately, most people don't know anything about this or how it works. But you can see in the history of this chart currently going back to 1998, it's very, very rare and very odd for the high yield credit spread to get below 3%. As you can see, it happened in 1997 for a brief moment, 2005. And then my favorite one is right here, May of 2007, got down to 2.46. This is directly before the great financial crisis, where everyone's pouring into junk bonds just to squeeze a little bit more out of their bonds. And, they were so like, the economy is just so strong. Like I could just, I'll lend to my neighbor. I'll lend to the dog across the street just for a little bit more yield. That's the way I see what was going on there. And then everything blew up, and a lot of companies went bankrupt, and these things went on a severe discount. And since then, we haven't even got below 3% very often, except for, let's see here, no, not in 2018. No, basically all the way up until today, 2.76. 6.7 rather. The market is not, this market is not pricing any risk at all. I don't believe intelligent investors are buying junk bonds right now. And I do believe very unintelligent, very stupid investors are buying junk bonds right now in mass, to the point where, I mean, they have to be buying these things like crazy in order for junk bond credit spreads to get this tight. This is a huge danger sign for me. Our central bank, the Federal Reserve, began its rate cuts in September with a 50 basis point cut. The Fed was fearful. They said, we don't want to see any more weakness in the labor market because the SOM rule was triggered. They saw employment go like this and they're like, uh-oh. And they did a double cut. And then in November, they did another cut. And as of today, they're expected to do another 25 basis point cut in December. Although that can change on a daily basis based on incoming data. We do have the CPI, for example, coming out later this week, which could, if it's weak enough, it could turn it into another double cut. But, you know, we'll see when that comes. Last daily reminder, the 3-month 10-year yield is still inverted. While some people are complaining, why is the Fed cutting? They're cutting, but they're still restrictive. When the 3-month, when you're lending your money for 3 months, you expect a lower rate of return than for 10 years. If you're lending for 10 years, you want a higher rate of return because you're risking your money for a longer period of time. You don't know what's going to happen in 10 years, but 3 months, yeah, we can do 3 months. So you want a lower return for 3 months, a higher return for 10 years. But when the Fed's restricting the economy, they're holding rates higher, you know, it gives the expectation that, you know, 3 months out, they'll still be higher enough. And with this still being inverted, it says that the Fed is still in restrictive mode. While the Fed is cutting, they're simply strangling the economy a little bit less. They're lessening the grip, but they're still gripping. They're still strangling the economy. This is one piece that I think is way too much ignored. And despite them saying we don't want to see any more weakness in the labor market, they're still strangling the economy. Don't die on us. Don't die on us while it still has its hands around the neck of the economy. You can't make this stuff up. With the daily reminders, we have the crystal ball readings that come from it. We'll start with the fact that the S&P 500, not the fact, the first crystal ball reading is that the S&P 500 is currently priced like it's a Ponzi scheme, relying only on other people to hopefully pay a higher price for it, even though it doesn't have the value to back it up. The crystal ball reading also says that the bear market is coming very soon, and also that the Fed won't cut fast enough to save the economy. And even if they try, we've had a lot of debt. We've become closer in the United States to a fiscal dominant situation. What that means is when a country has a certain amount of debt, it's paying enough interest on its debt to the point where monetary policy becomes less effective. And just like you saw when the Fed was hiking rates, trying to slow down the economy, and it didn't slow down and inflation got out of hand, we're on the other side of the coin now. Things are slowing down and they're cutting. Not very much. They're still strangling, mind you. But people are expecting, oh yeah, these cuts are going to set the market back on fire again. Not going to happen. Not according to me and my crystal ball. The Robschild portfolio. This is my own portfolio. This is how I invest my own capital. I currently hold about 57% of my portfolio in long-duration treasury bonds. Popular funds are TLT, ZROZ, and leveraged fund TMF. I wanted to bring up the TNX long-term head and shoulders for the daily reminders. Sorry for the mess on this chart. Pay attention mostly to the purple line here. So starting in 2021, we have a top in yields, and connecting to what I'm going to consider the neck to be of May of 2023 to December of 2023. So we have a shoulder, a head, a shoulder. We broke it, we retested it, and now we're headed lower. The target on this pattern for Treasury yields on the 10-year is around 2.8%. In addition to my view that stocks have become insanely overvalued, as when stocks fall, people, run to safety. They typically go into bonds. When people expect lower returns in the stock market, they seek guaranteed returns, which when they're over 4% still, treasury bonds, especially right now, seem like a very, very attractive place to be. And then, they can get overly optimistic at times too. But, that chart pattern, along with the valuation mismatch between stocks and bonds, tells me that long duration T bonds is, like I always say on many shows, TLT is my favorite place to be. While stocks in the US seem extremely overvalued, there are other markets that seem undervalued, one of them being Brazil, with a very large dividend payment. If you just hold the fund EWZ and collect the dividends and wait for Mr. Market to wake up to the fact that these companies are making massive amounts of money and actually paying and caring about their shareholders, I expect this market to eventually make sense. Right now it's like it's dirt cheap. Same with Chinese equities. KWeb, CWeb is a leveraged version of that. We saw a pretty good pop today in it. I'm expecting KWeb, by the way, to get to the target range of $45 to $50. I also believe that Nissan stock is an extremely undervalued stock. When you take a look at their assets and you take a look at the cash they have and the equipment, everything they have, if you were to liquidate the whole company today, the shareholders would make a ton of money, which is why I love that position. I'm 5% short semiconductors with SOXS. This is a fund that has triple leverage to go against semiconductors. Semiconductors, again, it's not Apple, it's not Nike shoe. These are companies that just produce a commodity. And once you have enough production, people are like, okay, now I have enough semiconductors, and they're still pumping out more and more, making more factories, like these companies are not worth, 40, 60 PE ratios. They're not. They're likely, in my mind, to eventually get down to sub 10 PE ratios. And right now they're way, way above that. Along with that, the chart pattern of SMH, the semiconductor ETF, has had all of these very large red candles at the peak of every one of these parts of the head and shoulders top that I drew here. White whale occurring here with a double engulfing candle to the downside. Very, very rare pattern, very extremely bearish. Most recent engulfing candle on the right shoulder being in October. I'm expecting this to head down to the neckline, and I'm expecting it to break the neckline. I'm expecting this to be flushing out here. I also have 5% in rare earth metals, fund called REMX. The value of this fund is around $45 right now. If you go all the way back to 2011, it peaked out at $230 a share. And these are companies that make money. They find battery like lithium, magnet metals, these metals that are required, by the way, for green energy and lots of fancy electronics and things. This is overdue market for interest to eventually come back. These are not companies that don't do anything or don't make any money. I believe this is a highly undervalued area of the market. As I discussed with junk bond credit spreads being extremely tight, I also own puts, leaps, which are puts about a year out on junk bonds on the fund HYG. The way I see it, if I'm wrong and all rates go up, well, then the value of HYG actually drops. And then with it dropping, and yields going up, the danger of bankruptcy increases, which will increase credit spreads further, pushing it down. And the other side of that is if the economy is slowing down and all rates are dropping, well, it means that junk bonds are going to be perceived as having more risk, also sending the price of HYG down. Basically, heads I win, tails you lose market kind of position. That's why I love puts on junk bonds. The show continues with my charts and such, but before I get there, the daily macro Monday daily reminder macro Monday is over, and wanted to put in here, thanks for watching. If you enjoy my 2 cents, you can support with your 2 cents or a like or any support the channel any way that you please. On to the next thing in the agenda regarding CEOs. Now, in the news lately, you may have heard something about, I don't know, some CEO, something to do with some CEO, right? Yeah, it's kind of waking up certain people out there to the frustration that people always have issues with corporate America. I actually wanted to add a little fuel to the fire, but it's unfortunate, or rather an unfortunate reality that, nothing's ever going to be fair. And at the end of the day, you're just going to have to deal with it. And I'll also end with that statement and that sentiment. But I just want to bring up a little case study regarding Tim Cook and buybacks. This is one of my pet peeves. This is something that was illegal, I believe, before 1980, and for very good reason. Buybacks, in my opinion, promote very bad corporate things happening. Basically, what happens is you have CEOs making the decision to use the company's profits to purchase stock in the market in order to purposefully elevate the price of the stock. And what it essentially does is it does increase the ownership size of everybody's portion, because when the company owns those shares, it's basically buying itself. The problem that I have with it is when companies are buying back shares when the shares are clearly extremely overvalued. There's no reason for a company to waste its money on something that's overvalued. That's irresponsible corporate finance. And unfortunately, CEOs will do that in order to make the books look better, in order to make the shareholders happier. And, at the same time, you have people like Tim Cook with Apple, by the way, dumping a total of, this is just the math behind the shares. I might as well, we'll get back to this. So first point, when was the last Apple buyback? AI, May of 2024, the largest in the company's history at $110 billion. If we look at the PE ratio of Apple over the past 14 years, was that a good time for the company? Was that an appropriate time for the company to be buying shares? By the way, it's like, okay, well, why are you making, why are you pointing out this company? Why are you making fun of this company? Like what, Warren Buffett isn't just dumping his Apple shares for no good reason. The shares they're really expensive. Looking back, let's see here, so this would be June of 2024. It was sitting at a PE ratio of 32. So overall, for any company, that's kind of high. But what about even this company's history? Well, going back to 2009, we range between 17 down to a price of $9 for $1 of return, $8.50 up to 13, up to a height of 18. And then since 2018, we've kind of gone into like overvaluation mode for a while. So why I'm picking on this, okay, it's sort of good for the shareholders because it just elevates the price, but Unfortunately, most of the people holding Apple stock are not going to be selling it because they don't know any better. They're dumb. They have it in part of like a bunch of funds that they have because their money manager put them in these funds that have Apple stock. Retirement accounts, retired people own this stock, and they are owners of this company, and this company is using the earnings of that company that belong to grandpa and grandma or whoever is retired. They're using those earnings to make the company richer, supposedly for the shareholders' benefits, but the shareholders are not benefiting unless they're selling. And billionaires are selling their shares in mass right now because they're not stupid, unfortunately. Unfortunately, the stupid people are the ones that aren't selling right now, while Tim Cook, very recently going to NASDAQ.com, what did we sold 253,000 shares on October 1st of this year, and then October 2nd another 224,000 shares. This is the equivalent of $107 million worth of shares in 2 days. This is after he helped decide the company to use those earnings that really belong to all the shareholders to, buy more of the shares back, increase everybody's ownership of the company, and he sells $107 million worth of shares. Now, I'm not saying that, maybe this was a scheduled thing. There are oftentimes things in contracts. I don't know the specifics of his contract, but there are often parts of compensation that involve forced selling, where he's required to sell a certain amount. It looks to me the previous years he hasn't sold this amount before, but certain conditions might force that situation as well. So I don't know all the details, but I do know who's benefiting from buybacks of companies that are clearly overvalued, and it's not mom and pop. It's Tim Cook and the other billionaires that are dumping their shares right now, all while retailers are getting real excited about stocks right now. They're you just look all over the news right now. Things are getting exciting when at one of the most scary times in stock market history, in my strong opinion. And the unfortunate reality about the whole situation, though, and this is what Ben Graham says in his book too. The unfortunate reality is that most shareholders don't know what's going on. They don't know they don't know any better, and therefore they lose. The common man is dumb and loses, period. Next thing on the agenda, CPI and PPI coming out Wednesday and Thursday. Could shake up markets. Now we go on to the charts. Starting with the SPX, the S&P 500, we had a pretty good crack to the downside, going down 0.61% today. This is after reaching that target of 6,100. I'm more neutral than I am anything in the S&P 500 as far as immediate price goes. I think it's extremely expensive, and I won't be surprised at all if it drops by as much as 80%. Not 8%, 80%. I'm expecting actually a 50 to 67% drop myself personally. But for now, I don't know what Mr. Market's going to do in the immediate short term. The Fear and Greed Index is actually showing completely neutral right now, And not only that, I bring this up every once in a while, the PY investing. A way to help alleviate drawdowns in the market is going further into cash. Now 85% stocks, 15% cash. I said on Friday Bitcoin was looking bearish because of this candle. Apparently you can see it pretty easily. I was zooming in. We have this giant wick on the top and the bottom. This is a reversal candle. I don't think Bitcoin will continue higher here. In order for it to continue higher, we need a daily close above 103,000. And if we also not to discount the bottom side of this, if we close below 92,000, it's expected for us to get down to around the $73,000 level in Bitcoin. Altcoins, I don't often bring this chart up, but it really caught my eye today with the movement of the market. This is looking extremely bearish. It was a larger red candle earlier today. We still have 50 minutes on the clock. This is the total market cap of all altcoins put together, excluding Bitcoin. And this is a very scary engulfing candle, suggesting that the altcoins are about to get hit pretty hard. I mean, as it is already today, we're already down 9.9%. This is looking extremely bearish. And then last chart of the day, K-Web. I brought it up in, it's about 10% of my, or 13, or I guess now that it's gone up, it's probably like 15 or 16% of my portfolio. But we had a very large move up for an entire index today. This is on the back of China coming out and saying, yeah, we're going to stimulate more. And the market's like, oh, okay, I guess it's not actual garbage, all of the stocks that you have over there, even though they're priced like garbage. And so we were able to go up by 10%. Again, I still think it's undervalued at between $45 and $50 of the value of this fund based on valuations. I think it's still cheap actually in that range, but not like, blood in the streets, like cigarette butt dirt cheap. So I'm happy to be sitting in this fund until it gets back up to what I consider to be a more reasonable price. Again, main thing with investing internationally is that businesses run the world, not politics, and businesses produce things and they make money, and that's it. Do you want to own that? Do you want to own the production of things? Then, buy cheap stocks, or rather buy stocks, especially when they're cheap. And that's all. Is that all? That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.